Many retirement saving strategies focus less on hitting big wins and more on preserving what you've built. Here are some investment types worth avoiding if your goal is a safer and more stable retirement. Collectibles like art, sports cards, or rare coins can be difficult to value accurately. While online marketplaces have boosted interest, the market is highly speculative. The Beanie Baby craze in the 1990s is a good reminder. At the time, many believed they were making smart investments. Now, most are worth very little. Complex derivatives and options may offer big potential gains, but they require precise timing and expertise. One mistake could result in serious losses, especially dangerous for retirees with limited time to recover. A diversified mix of stocks and bonds is usually a more balanced approach. Crypto markets are known for volatility. Even tweets from well-known figures have been known to cause price swings. For example, Bitcoin dropped more than 3% after a single tweet from Elon Musk. This unpredictability makes crypto a poor fit for those living on a fixed income. Instead, consider stable alternatives like inflation-protected securities. Structured notes combine elements of bonds and derivatives. While they may seem safe, they often have confusing terms and limited transparency. Without liquidity or guaranteed principal return, unless held to maturity, they could do more harm than good. High returns from foreign emerging market bonds can seem attractive, but they also come with political risks, currency fluctuations, and the potential for default. Safer options include U.S. Treasury bonds or investment-grade municipal bonds, which tend to be more stable. Annuities can be helpful in retirement planning, but some carry high fees and surrender charges that eat into returns. Terms can also be hard to understand. Look for lower-cost options or income-focused mutual funds that offer clear, straightforward terms. Borrowing money to invest adds an extra layer of risk. If the market dips, you could end up owing more than you invested. For retirees, it's usually better to avoid leverage and stick to lower volatility investments. Investing in foreign real estate might sound appealing, but unfamiliar laws and economic instability can create major problems. Currency changes and local regulations also pose risks. Domestic real estate or US-based REITs offer similar exposure with fewer complications. Penny stocks can be tempting, but are often tied to high volatility, fraud risk, and even total loss. The federal government has issued warnings about them. Instead, mutual funds or ETFs with a long-term track record could offer more security. While private equity and hedge funds might promise high returns, they tend to be expensive, illiquid, and not guaranteed. It could take years to access your money. Retirees often benefit more from index funds or diversified portfolios that are easier to manage. Flipping properties takes significant capital and labor. If housing markets shift or repair costs spike, you could end up losing money. REITs provide exposure to real estate with less hands-on risk and fewer upfront costs. Putting a large amount of money into one stock, even a blue-chip name, exposes you to big losses if that company falters. Nokia is one example of a former powerhouse that lost most of its value over time. Diversifying through index funds or sector ETFs can reduce that risk. Raw materials and agricultural goods are sensitive to politics, global events, and weather. While they're essential in the global economy, their prices can be highly unstable. If you want some exposure, consider doing so through diversified funds that manage risk on your behalf. Retirement is about preserving what you've worked hard to build. While the promise of fast gains may be appealing, the risk involved can lead to serious financial setbacks.